For the things we have to learn before we can do them, we learn by doing them. Aristotle. Here we went in and traded the wobble, and the best way to learn when it comes to trading is to trade. Sean talks through exactly his day-to-day trading, showing me how to organize these stacks and where the vital areas are to watch to be a successful trader. We've had an incredible journey up to this point, getting to know the ins and outs of the wobble technique, and we've talked a lot about different moving parts. And now it's kind of we get to see it all in action, and I'm excited for this part where we actually get to kind of take what we've talked about and apply it. And so from that, yeah, I'd love to have you show me how do we apply the wobble technique.
Yeah, absolutely. So we've got the market open here, and what we're looking at is the euro. It's kind of later in the afternoon right now, so the market's not moving very much, and you can tell by the candles that there's not a lot of activity. But anytime we sit down and use this technique, it kind of has to check a few boxes. Okay. First of which is you have to have a really good setup on a higher time frame chart. So if you look over here, we've got right now what we're looking at is a trend on the 5-minute chart, and we've pulled away from that trend just recently, and we're starting to break that trend right now. And so what I'm looking for is I'm looking for this market to retrace a little bit of that trend and move back down to some layer of support. So basically just a general reversal trade. So the wobble technique's that's the strategy, that's the setup. Okay. And the wobble technique is what we're going to use to actually enter and start managing this trade. And so as we talk, I'm going to be doing a little bit of managing while we talk. The other thing that you have to be aware of is what is happening on the higher time frames, not just the 5-minute, but even the bigger time frames. Where is the bias? And so if we come and look at the bias in the market, we're going to see that the bigger pressure, this is what we're trading the reversal of this, okay, right? Mm-hmm. But the bigger pressure on this market is down. You see that? Yeah. So that bias, we're going to use that bias to our advantage, and we're going to assume, through what we looked at previously, we're going to assume that this is a little overextended. That bias is going to kick in, and we're going to have the market start to drop from here. So that's the big picture, right? Those two things are really important to us. The next thing we do is we have to calculate how much we want to risk on the trade. So in this case, we're trading a $60,000 account. So just real quick math, what I typically do is take 60,000, multiply it by how much I'm willing to risk on a trade like this. So let's say I'm willing to risk 2%, okay, or 1%. So take that 60,000, multiply it by 2%, let's say. That gives us $1,200 of risk. Okay. So if we lost more than $1,200, we would be taking more risk than 2% on that trade, and we'd be violating our rules at that point. So it's really important that you determine how much you're going to risk on any given trade. Once you've determined that, then you come into the market and you look and see, okay, if this trade doesn't work out, where do I get out? Where am I going to bail on this trade? And so looking at the chart here, I would say that this high is a good bailout point, right? Yeah. If the market rallies all the way up from here and doesn't give us our reversal, then we're going to just close out of the trade. So now what we need to do is we need to measure the distance between where this trade triggers, where it starts to break this point down here, all the way up to that top, and that's the most that we will lose on this position. So that's our max loss per position. So we take a measurement from there all the way up to where our stop point is, and it says it's 25 pips from where we're at to, or from where this trade will trigger to the stopping point.
So 25 pips is where you would want to put your stop losses.
Yeah, well, yeah, any stop loss would need to be triggered before that 25 pips.
Okay, that makes sense.
So each pip on a full contract, each pip is worth about $10 on the euro, right?
Okay.
So if we take our 25 pips, multiply that by $10, that means each contract could potentially lose $250. If we're absolutely wrong, each contract that we're in would lose about $250 at max.
Okay.
So then we take our maximum risk of 1,200, divide it by the 250, which gives us roughly 5 contracts. So this is for, what we're talking about here is trade setup. This is what we would do on any trade setup, any strategy that we would employ. We would go through this process of determining how much am I going to risk on this trade, how many contracts does that represent.
Sure.
And so that's the outer edges of what we would be willing to put into a trade like this. So in this particular setup, we can go up to 5 contracts without any trouble. Now this is where we get into the wobble technique. Okay.
So everything we've done up to this point is just standard trading practice. Now we're getting into what the wobble technique really is, right?
Yeah. Again, we're just setting everything up. So this is all the homework that has to get done before the trade ever fires up. You know, a lot of folks just get into a trade, right? You know, they don't go through that setup. They just jump into the market. They start trading, and they don't know how much risk they're taking. What you'll discover when you watch me trade is I'll often tell you that I'm going up to 6 contracts on this trade or up to 10 contracts on this trade. What I've done is I've gone through this same process that I just walked you through and said, okay, given this setup, I can risk up to 10 contracts without having any danger of losing more than what I'm willing to lose on the trade.
And it's great that you showed us this because, like you said, if you're just getting started or brand new, you need to go through these steps. But when you've traded as long as you could probably just do the calculations really quick in your mind.
Yeah.
Right?
So this is just basically, for those who are familiar with the apiary fund, this is the Benjamin formula, right?
Yeah.
So this is just real basic. How do I determine how many contracts I'm going to be in? We work that backwards, right? We start out by asking the question, how much am I willing to risk? 1%, 0.5%, 2%, whatever that is. And then we use that and our setup to calculate how many contracts, our max contract size. So we can get into upwards of 5 contracts on this trade, right? So now what I'm going to do is I'm going to divide that 5 contracts, our max position size, into smaller stacks. Okay, so these little stacks I'm going to use as layers in the market. So I've already layered into a couple of small layers here. I've got a small layer here, and I've got a small layer here, but I'm trading really small, so I haven't really truly set up any kind of a trade yet. So the next question I ask myself is, how many layers am I going to need in this setup? So to calculate that, I look at where we're at right now, and where's our stopping point, and I try to identify all the support and resistance layers in there.
Just for somebody just starting out, trying to understand this, would you recommend drawing on their chart in the beginning stages every time, or is that a useful tool for us?
Drawing on the chart, absolutely, yeah. I mean, you need to know where all these layers are, because this is where decisions are going to be made.
Okay.
Whether you're going to enter new positions, another layer into this trade, whether you're going to take off different layers. So if this market continues to move away from us, you can see that it's going to break through 1, 2, 3, 4, 5, 6 layers before we get stopped out. Does that make sense?
It does, yeah.
So we're going to take that 5 contracts and we're going to now divide that into 6 stacks. Does that?
Yeah.
So 6 stacks, you know, roughly that's about 0.8, 0.9. I don't know what the math is off the top of my head. We could calculate that real quick. 5. We could go 5 divided by 6. So 0.83. 0.83. And if we added 0.83 stack
Stacks
at each of these layers, that would be what we call an equal size stack at each layer. I prefer not doing it that way. I prefer in different scenarios to start out small and then build bigger, so that would be more of a ratio stack.
Do you do that from a confidence standpoint? You start out small, then when the trade forms in the direction you want, then you start stacking them more? Is that why, from a confidence, you're more confident about the probability of the trade at that point?
Yeah, obviously the either more confidence, but what it also does is it helps move your cost basis in the trade faster. So if you start out small and then you get slightly bigger, this is, you know, there's a concept in trading called a martingale or an anti-martingale, depending on, and the idea is that as you increase your position size as you move different layers. Now, I don't recommend the martingaling, you know, and most traders don't, simply because they use it wrong, right?
Sure.
In this case, it's all part of one setup. We know where we have a very defined exit point, and all we're going to do is we're going to use martingale. We're going to use different sizes at different layers to help move our cost basis up or move it down, depending on what direction we are in the trade.
Makes sense. Yeah, no, I understand that. That's good.
So just like anything, there's a good time to use things and a bad time to use things, and part of the battle is knowing when to use. You know, you can't just you can't just have a blanket statement and say martingaling is bad. Well, there are times when martingaling is good, if you know where your parameters are and you know where your sets are. There are times when it's bad if you're just, you know, you're doing it to try and you're hoping that the market moves your direction.
And I'm sure that just like martingale and maybe other various types of techniques or strategies, there's a beginner, intermediate, and advanced level of learning that goes along with that. Would you agree?
Yeah, absolutely.
What would you say with the wobble technique? Would you say this is more intermediate, advanced, or is it something beginners could just use right out of the gate?
A beginner can use this technique, obviously. You can go in, you know, with 3 stacks, and of one, each stack being, you know, 1 lot or you know, equal sizes.
Sure.
So you can make it as simple as it needs to be or as complicated as it needs to be. But the concept of using this technique anyone can use it.
Personally, from my standpoint, that's why I love about it. It's one of the #1 things I love about it, is because of the simplicity behind it. And it doesn't take a degree in economics or mathematics to figure out how to deploy the technique.
Once you know where your stacks are, then it's just a function, the technique is just a function of entering into the market at the different stacks. So right now we're coming up against one stack level. So we can build this, if we're going equal stack size, we could build this account size up to, we could build this account position size up to 0.87. Okay. So we can start out, we're at 0.4 now, 0.5, 0.6, 0.7, and 0.8, because we're up against one layer.
I see that, yeah.
Now, if this market breaks out away from that layer, then we can add another stack to it. So now we're going to start to wobble in and out of different positions while we start to build for the market to drop from here.
I love that word. It just makes complete sense with this strategy.
The wobble?
Yeah.
It really does. It's a very effective word. All right, so let's clean these charts up a little bit. So we know the layers that where we're going to get in. And let's watch this market for a second, because there's a chance that it could break up and hit that next level. See, it's doing it right now. So now in most cases, most traders would be very, very sad, you know, or frustrated that their trade hasn't worked out, right?
Right.
And one of the advantages of the wobble technique is that I don't need to worry about this, because I've got 5 layers in this case. I've got 5 layers before I know that this trade isn't worked out.
You're not all in on one trade.
Not in,
Yeah.
not all in,
Yeah.
yeah. So if this market rallies up again, up to that next layer, then we're going to just simply add another stack to the market. Now, what makes this wobbling is that at the same time, this trade does not actually trigger until the market breaks the trigger bar, and that's that apex right there. So this market will not this trade formation on the 5-minute chart does not actually trigger until we until we break that line. That's the trigger bar for the setup. And so what we're doing is we're entering in at all these different layers, but we can also take off inside these layers. And so we're going to start to book profits if this market comes down. What we'll want to do is book a little bit of profit in into the account. If it goes back up, we'll add another layer until we're back up to 8.87. Okay, so that's running almost up to that next. It ran almost up to that next layer. Didn't quite hit it. Markets never cooperate with us, do they? So let's see if it gets up to that layer. There's a good chance it will. Which case, oh, perfect, right now. So we're going to build another layer in that. Now I'm going to go a little bit heavier on this layer, because this seems to be a little bit of a resistance, a strong resistance level in the market.
Okay.
So I can choose to build a bigger layer here, or I can choose to build a bigger layer here. It's just whatever that stack is. I can't exceed the total from my max position size. So I can never let this get bigger than 5 contracts.
And then I like what you said. I mean, you decided to go a little bit heavier because you saw that there was a little bit more of a support area in here as opposed to the next layer. Is that right?
Exactly. Plus, another thing that I don't want to do in this particular situation is if this comes down, I want to be able to take some profits off, but I still want that stack layer, some of that stack layer on the books.
Okay.
So when it drops and breaks or triggers the setup, if it triggers the setup, then I'll have a couple of really good trades on. Does that make sense?
It makes sense, yeah.
All right. Next thing we want to do is we want to take a look at where all of our profit targets are, where all of our take profits are. So I've got it just mechanically set at 2 pips because a lot of what I do is I like to book 2 pips on them in the market all the time.
They add up?
They add up. And so what I'm going to do is I'm going to start taking a couple of these and I'm going to put them down at a profit target layer for the setup. So if this thing reverses and drops lower, then this is our next major support line on the 5-minute chart. So this trade setup should go from where it is all the way down to that point, in which case we'll close out the trade and walk away with a profit. Now what I find, oh look, see it rallied all the way up to that next layer, so we're going to go ahead and start to build another short.
So obviously the trades you're entering in right now, if it does get into the trade and triggers the actual trade that we're looking for, these ones will yield the most profits because it's gone up to that higher layer. Is that right?
Mm-hmm.
And so you would adjust those take profits of the better trades, or is there a sort of a method to which take profits that you adjust?
That's a function of preference.
Okay.
Okay. So in reality, it'll all work out mathematically anyway, whichever way.
Okay.
So it all works out in the end. And so if you like to not see a negative on your position size, then you close out, the ones that are on the negative, and then you don't see them. And what you're left with is the very best trades, and then you're like, oh, I'm the best trader in the world.
Give you a little bit of false sense of security, I guess.
False sense of security goes a long ways in your trader's psychology. All right, so now what? We just added another layer in, and the market is dropping. So we've got we could take a little bit of profit, which we're starting to do right now.
Okay.
Is take a little bit of profit. So now that we're all through the wobble technique, we're booking profit into the account, booking it into the account, booking it into the account, booking it into the account.
Just like right there,
just like that. And it's going to take off that entire layer if I don't adjust our profit targets. So let's take one of those and let's just put it down here.
I gotta say that I just got, I've said it, but I gotta reiterate it, that I love the wobble technique so much because in my before I had the wobble technique in my trading, I would say, oh, here's the trade setup. I know it's gonna come down, and so I would go heavy, but then it would go the other way, and you would be all in and wouldn't be able to have any way to maximize your profits.
Yeah, that's part of the challenge with the way most traders trade, right? Mm-hmm. Is they rely so heavily on their setup, and they attribute the max position to their setup. One trade, one hit, and you're done, right? The way that I approach the market is I can be very, very, very flexible in the market because I'm constantly adding layers, taking layers off, putting profit into the account, all while this market is trying to set up for some kind of a move.
Yeah, I mean, when does the market ever do what you think it's going to do 100% of the time?
Yeah, very rarely. So now you can see we're now positive on the trade. We've already booked some profits and we're positive on the trade, and the trade hasn't even fired. So the setup hasn't even happened yet. But we're profitable. And another thing to remember is that this is all part of one setup. So I've placed already several trades, quote unquote trades, on the books, but it's all really one trade setup. And that confuses a lot of people because they'll say, hey, Sean, you just lost money on that trade. Well, not really. I'm up on the trade. I'm down on this part of my wobble.
Right.
On this part of my stack, I'm down here, but I'm up overall on the
I think
trade.
it's important to know the difference between a stack and a trade.
Yeah.
Right? I think those are two different things. The stack is inside the trade, right?
Right. Yeah. All right, so now we've just peeled off. We're down to less than one stack. So remember our stack size is 0.83. We're at 0.55 on the books. So now if this market rallies back up again, which we've all seen that happen so many times, you think, oh, this trade's going to finally trigger or finally fire off, and then we get another rally in the market. The beautiful thing about the technique is that we just do the same thing over again, right? When it gets up to a layer, we add another layer, or we add another stack. And we just keep doing this, wobbling in. This is why we call it the wobble technique. You're in here, you take it out there, you're in again, you take it off. And meanwhile, you're just waiting for the trade setup that you're looking for
to trigger.
Yeah.
This makes a lot of sense. Quick question: if it comes down, hits or takes profits inside of a stack, would you add more to if to the 0.83? If you're inside that stack, if it comes down, hits or takes profits in that stack, would you add more to that stack, or would you kind of wait and see what direction the market's going to go?
Yeah. Again, the beautiful thing about this is that you're in control of how many you put on at each level. So in the beginning, it's really helpful to just kind of really identify each level, right? Yeah. So we just broke through a level. There's another level right here and another level right here. So theoretically, we could still work all of these different levels and add more this time, less next time, more, less, and we can just work it. You've got a lot of flexibility in how you implement this technique.
But you never want to deviate from your rules.
Well, ultimately, the big rule is you never exceed that 5 contracts. You just never do that. Okay. And as long as you can do that, you can see, we'll book profit, book profit, book profit. But if we never break that 5 contract rule, we'll never lose more than we were willing to lose on the trade in the very beginning. Plain and simple.
Yeah, you're within your risk parameters.
If this comes up to that red line again, I'm going to start building another stack, which it almost rallied up to hit that. But you can see we've got a stack, a layer here, a layer here, a layer here, and a layer here. But you can see they're all kind of right around those lines that we put in. Decision lines. All right, so let's throw one on here. Throw a couple on here.
The Lucas lines.
The Lucas lines. Yep, the Lucas lines.
Well, I've never seen anybody present this technique, so it's the wobble technique the way you do it. So you've created it. So we'll call them the Lucas lines.
The Lucas lines. I like it. The Lucas lines are lines of decisions. It's that point where you have to make a decision. Am I going to trade here or am I not? The nice thing too is that it shows you, I've got all my decision points laid out for me. I know exactly where I'll make decisions in the market. All right, so now we're back up to just over 1 1.25, 1 1/3 lots. And I think what I'll do in this situation is there is a chance, obviously, that the market could break that and move higher. So I'm going to hold off on adding any more until the market gets any more shorts, until the market gets up in there. there's also a really good chance that the market could reverse here and move lower. And I've got several profit targets down here. So again, what I'm going to do is I'm going to take a couple of those profit targets and we're going to move those down to the major profit target for the trade.
For the trade target.
The trade target, yeah. Now it gets confusing when you start talking about this trade, that trade, all these little stacks. I know it can get confusing, but hopefully it makes sense what we're just trying to do.
Well, repetition, right, is the key. Is just doing it the same time or the same way, and then it'll happen, right?
Yeah, like you'll start to understand. What happens is you start to understand a little bit better about how the market moves, and this technique helps remove a lot of the anxiety in your trading, because when you go all in, your anxiety level
it's
is
a make or break.
max,
Yeah, you got to make or break that trade, right?
And so you can kind of think of this technique as having, it's not just a wobble technique on wobbling into the trade, but it's also helping you manage your stress levels while you're in a trade, your anxiety levels.
It's your Xanax for your trades.
Xanax for trading. I guess you can think of it that way. Now, it's afternoon now, so this market might get really quiet. So it may not fully trigger the way we want it to trigger, but I think what I might do, it's slowing down and moving into some consolidation. I may just add a couple more here. Oh, perfect, even better.
Yeah. See, I've never had a trader, or I've never been around a trader that says, oh, the trade's moving not in my direction, but that's great.
I know.
It's kind of a little bit backwards in a thought process from the way traditional traders trade, right? But that's the beauty. That's the beauty of the wobble technique. Is if it does go against you, you just get the opportunity to say, "Oh, now I have a better opportunity to make more money."
Yeah.
And that's the way you look at it, or have to look at it, right?
Yep. And we'll take a couple of these and put them down at our major target level. Oh, now it's going to rally up.
So obviously we're in a kind of a lower volatility. Is there certain ways that you would trade depending on volatility?
Yeah, the wobble technique works really well in volatility because, you've watched how slow this market's moved. Imagine speeding that up, right? So you're booking profit, adjusting, adding a layer, taking it off. It can get a little bit confusing if you're not practiced at it, but the volatility actually creates opportunity. And so I prefer trading this technique in higher volatility markets. Just because of that, because I prefer that, what I tend to find one of my weaknesses is that in slower volatility or lower volatility markets, I tend to build my positions too fast and don't allow, that good distribution at these different layers. I end up getting a little heavy at these lower levels, and that's problematic.
That's a great tip.
Yeah. Learn it from me, folks.
Stay true to your levels, right?
Yeah, stay true to your level. I just moved my level. That should go right there. Or no, that shouldn't go there. It should go right there. All right. So again, we're now booking some profit in. So we just did another wobble, right? We've wobbled a little bit here. And let's see if this market actually drops. Now you notice how these two take profits aren't at the ideal point. right when this market should be picking up, I'm closing these trades out. So if I want to maximize my income, I've got to adjust those.
Okay. I was going to ask, are you going to move them, or yeah, that makes sense.
So if not, then I've missed out on potential income, right? Because it's not at a layer. It's not at a layer. And next, the other thing is I've got a whole lot of these here. So I can adjust this. So I've got a little bit of profit target here, and then when the trade actually fires.
All of this is just setting up for that one trade.
One trade.
Yeah, that's amazing. But you're already booking profits before the trade even happens.
Yep. That's the beauty of the wobble technique.
Yeah, that's awesome.
And it, I've had it happen so often where, the trade doesn't fire off, and yet I've made loads of money.
It doesn't matter at this point.
Doesn't even matter.
It's just gravy.
Yeah. Or, I've got a meeting coming up or an appointment, and I've got to leave. The trade hasn't, the trade setup hasn't triggered, but I'm profitable, so I'll just close it out and walk away from it. So that's always a good thing. Remember those stages that we talked about in a trade. First thing you're going to try and do is like minimize risk or loss, potential loss. Right. That's stage one. And then you get into this, okay, now no matter what, I've got to break even. Well, we're already beyond that stage of the trade setup, right, and the trade hasn't even triggered. All right, now we've booked a little bit of profit in the account again, and now this is the moment where the actual trade is about to trigger. Or not.
Yeah. Or is it testing, right?
Or
is it gonna trigger?
And for me it doesn't matter, because if it comes and bounces off this layer, all the better, because I'll just I'll wobble some more. Eventually this market will drop and break these levels, and then I'll be in really good shape. So there it's firing off. And we would now, this doesn't necessarily mean that we have to end wobbling either, right? Just because that trade is triggered, if it rallies back up to another layer, I can still wobble, and I can wobble all the way down to our profit targets down here.
Depends on how fast it wants to
it wants to move.
Yeah. A beginner can use this technique. You can go in with 3 stacks, each stack being 1 lot or equal sizes. You can make the technique as simple or as complicated as it needs to be. The concept of using this technique is that anyone can use it.